You know that feeling when you hear the economy's doing great, but then you look at your bank account and it's telling a totally different story? Yeah, you're not the only one. We're going to get into what's really going on in what I'm calling the economy of emotion.
I mean, on one hand, the headlines talk about cooling inflation, a strong job market, but on the other, so many of us are feeling this financial pressure. It just doesn't add up. So, why does the economy feel so strange right now?
Well, it's not just in our heads. The market intelligence firm Razi hit the nail on the head, calling it a disconnect between data and daily life. And that's the mystery we are going to unpack right now.
So, let's really dig into this disconnect. It all starts when you look at two charts that honestly seem like they're from two completely different planets.
Okay, let's break this down. On one side, you've got total consumer credit. See how it just keeps climbing? That's our behavior. That's what we do. But then look at the other side, consumer confidence. It's a total roller coaster, right? Up and down, all over the place. That's how we feel. And that right there, that's the disconnect we're talking about, staring us right in the face.
And here are the numbers to prove it. Our collective debt as consumers, it's blown past $5 trillion. But at the exact same time, our confidence in the economy has tanked, hitting lows we usually only see during a massive financial crisis. So, how can both of those things be true?
Well, the answer isn't just in the spreadsheets. It's in our heads. It's about psychology. Turns out the way we feel about money has this really specific, kind of weird relationship with what we actually do with it.
And the key idea here is something called consumer confidence. Now, this isn't about how much cash you have in the bank. It's a measurement of how optimistic or pessimistic you feel about the future. It's basically a way to put a number on a feeling. So, researchers dug into over 4 decades of data, all the way from 1978 to 2024, to figure out how our feelings and our borrowing are connected. And what they found was, well, it was a surprisingly lopsided relationship. It's like a one-way street between our emotions and our actions. Here's the first part of what they found. When our confidence gets a boost, when we start feeling pretty good about the future, our borrowing goes up right along with it. And as you can see, this isn't just some quick blip. It's a sustained thing. Our optimism literally fuels our spending on credit.
But this is where it gets really interesting. What happens when you flip it? When we go out and take on more debt, you'd think our confidence would just crash, right? But it doesn't. There's this tiny, temporary little dip, and that's it. That feeling of anxiety from borrowing more, it just doesn't stick around. Our confidence bounces right back.
So the big takeaway is this. Our feelings are a powerful long-term driver of our debt. But our debt is not a powerful long-term driver of our feelings. That imbalance right there helps explain why that debt chart just keeps going up and up, even when we say we feel terrible about the economy.
So our psychology is pushing us to borrow. Got it. But that's only half of why we feel so squeezed. The other massive piece of this puzzle is inflation. And it turns out the way we measure it makes a huge difference.
We hear that word inflation all the time, but did you know there are two main ways it's measured? First, there's the CPI. Think of it like your personal shopping cart. It measures what you're paying out of pocket for the same basket of stuff month after month. Then there's the PCE. This is the one the Fed really pays attention to. It's more like a national shopping cart. And it's smarter. It sees the price of beef just shot up and knows, hey, people are probably going to buy more chicken instead, and it actually accounts for that. And this stat right here just perfectly illustrates that disconnect. Since the year 2000, the CPI has, on average, been almost 0.4 percentage points higher than the PCE. That little gap helps explain why the official numbers from the Fed might sound okay, but the price you're actually paying at the grocery store feels a whole lot higher. Of course, high inflation is nothing new. And as you can see, big spikes have been caused by completely different things over the years, from this huge surge in demand after World War II to the oil shocks in the 70s, and most recently, you guessed it, the supply chain chaos from the pandemic. Every era really does have its own flavor of economic pain.
All right, so we've got the psychology of debt and the nitty-gritty of inflation. Now let's tie these big ideas back to what really matters: your money, your wallet, your future.
So, how does inflation really hit you? Well, it eats away at your purchasing power. That dollar you saved last year,
it buys less today. That can make it harder to save for retirement. And it creates this bizarre situation where it actually helps borrowers, whose debt is now easier to pay back with cheaper dollars, and hurts savers, whose cash is just losing value. But check this out. Here's a surprising twist. Even with all the inflation we've seen lately, from 2019 to 2022, the typical retirement account balance actually grew by about $11,000, even after you account for that inflation. How is that even possible?
The answer comes down to what you own. See, in an inflationary world, just holding cash or certain bonds that pay a fixed amount, well, that's a losing game. Their value just gets chewed up. But assets like stocks, real estate, and commodities, they tend to do much better because they represent real things whose prices can also go up. A strong stock market is a huge reason why a lot of retirement accounts actually came out ahead.
Okay, we've covered a lot: psychology, how we measure things, the personal impact. Let's put all these puzzle pieces together and finally solve that mystery we started with. So here it is, the full picture. It all starts with our feelings, which are a powerful force driving us to borrow. That creates this steadily rising mountain of debt, no matter how anxious we say we are. At the same time, inflation, which probably feels higher than the official numbers, is quietly eating away at our paychecks. And there you have it, the mix of rising debt and shrinking purchasing power. That's the gap. That's the disconnect between the headlines and how we feel. So when you boil it all down, our economy is never just about the numbers on a screen. It's a deeply human story. It's about psychology, our habits, and what it really costs to live our lives every single day. And that leaves us with one last big question to think about. If our collective feelings are powerful enough to shape our entire economic reality, what's the next big feeling we should all be watching out for?